Most people think of debt as a dangerous game to play. We all grew up listening to advice from mamas, papas, aunties, and uncles saying, never get into debt. Buy only what you can afford. Owe no one a dime. Debt will get you into trouble. And so on. But there are so many angles from which we can look at debt. The questions to ask are, what does debt stand for? Is debt necessary? If I must get into debt, what kind of debt should I get into? Also, what kind of debt should I avoid? First, let's look at it in the simplest form. Debt happens when one party borrows money from another party with a promise to pay back. The party that's borrowing could be an institution or an individual, while the party that's lending can be a publicly owned or privately owned institution. For instance, to take a loan, there has to be an agreement. There has to be a repayment plan. The amount received should be paid back in part or in full over an agreed period. In most cases, the money borrowed is paid with an interest. A debt can be secured or unsecured. Secured debt means the borrower will deposit an asset as collateral before the loan is given. Examples include auto loans and mortgages. If the person that borrowed money fails to pay back as agreed, the lender can sell whatever's been pledged to recover their money. On the other hand, an unsecured debt is not backed by an asset. A good example of this is credit card debt. But it doesn't mean that you'll go scot-free if you fail to pay back. Before we continue, I'd like to know, are you getting any value so far? If you are, kindly like this video and go ahead and click subscribe. Done? Good. Let's move on. Is debt good or bad? In my opinion, there's no direct answer to this. The reason is this. Any attempt to give a straight yes or no will raise more questions. If I say debt is bad, then the question will be, why are the richest individuals, companies, and nations owing it? On the other hand, if I say debt is a good thing, you may ask, if it's so good, why do several individuals and families spend a lifetime struggling to pay debts? So, a better answer will be that debt is both a good thing and also a bad thing. It depends on what kind of debt you're talking about. If you borrow money to buy an asset, such as a piece of property, maybe such as a rental building, as long as the income from that property is well above the debt you're paying, then it's a good debt. In this case, you borrowed for investment. Let's look at the flip side of it. If you borrow money to buy a piece of luxury, such as a supercar, designer wares, jewelry, or you take an expensive vacation, you've borrowed simply because you can't afford it. In this case, you've taken a bad debt. You'll end up paying for what you don't even need. You only made yourself a slave to your desires. This can also be seen in the corporate finance system. Companies borrow money to finance their businesses for growth and expansion. When the debt taken by a firm is moderate, if the interest rate is low, and the time frame for payback is long enough, then the company can survive emergencies. But a company that has a large amount of debt may not be able to pay it back if there's a drop in sales or major global shocks. We saw much of this during the COVID-19 pandemic. Many companies had to go under because they could not continue to run their businesses. For several months, there was a massive drop in sales. Another way to look at it is, when a company uses no debt at all in business, such companies will be missing out on necessary growth opportunities. This can happen when an organization has no vision for expansion and is happy to operate on a small scale for a long time. Types of debt. Mortgages. When you borrow money from a bank or any other financial institution to pay for a piece of property, that's a mortgage. Usually you can make a down payment or a part of the total amount and take up the rest on mortgage. Let's say you want to pay for $1 million property. You can make a down payment of $400,000 and take up to $600,000 on mortgage. $600,000, which represents 60% of the total amount, will be financed by the bank. This will spread out for you to pay back over some time. You will have to pay this money with interest over a time frame that could be as long as 30 to 40 years. In a situation that you fail to make these payments, the financial institution will sell your property to get their money back. To most people, this is about the biggest personal financial decision they'll ever make. According to a 2017 debt study made by NerdWallet, the average American carried a mortgage balance of almost $174,000. Business debt. A small business may need to take a loan to grow the company. This money can be put into commercial adverts, hiring of new staff, or renting of office spaces and warehouses. The company must make a proper review of its market and the cash flow before taking this step. For instance, if a company has created a product that's in high demand and they have an effective management structure, then this type of loan will be good for them. All they require is to hire more workers and rent more spaces for expansion. But if a company takes this type of debt without proper review and planning, then they may run into a problem when they can't pay back the money. They stand the risk of losing their assets to the lending institution. The rule of thumb is never go into too much debt. It could choke your cash flow and disrupt payment. Corporate debt. A corporate body may consider borrowing money through options that are not available to individuals. Two types of corporate debts are: 1. Bonds. This is the type of debt that occurs when a company promises repayments to investors. For instance, a company that we shall call SpeedX needs to acquire a set of ultra-modern equipment for increased capacity. If the amount that SpeedX requires for this purchase is $1 million, then it can issue 1,000 bonds with a face value of $1,000. Investors who intend to hold these bonds will be promised a payback of the face value at a future date when the bond matures. Let's pretend you bought 100 bonds as an investor. You'll get your $100,000 back at the end of, say, 5 years. You will get back your initial investment, in addition to regular interest payments in the upcoming years. We can say that bonds work like the backside of a loan, because the company, in this case, is the borrower, while the investors are the lenders. 2. Commercial paper. This is a short-term corporate debt that has a maturity period ranging from several days to 270 days. Companies use this type of debt to finance short-term liabilities, such as payroll, corporate meetings, accounts payable, and inventories. Commercial paper is not backed by collateral, which makes it a kind of unsecured debt. For this reason, it's only issued by companies with high-quality debt ratings. Only a company with high-quality debt ratings will be able to find buyers fast. It's usually issued at a discount from the face value. Credit card debt. Credit card debt is a form of unsecured loan, and it's among the most common and most expensive in the U.S. A report has shown that American consumers are carrying more debts on their credit card, and it's becoming more difficult to keep up with payments. However, when you put the credit card to proper use, it gives you a whole list of advantages over paying with cash. To have a healthy credit card rating, you must avoid: 1. Buying things you can't afford. 2. Maxing out the limit. 3. Not paying your balance monthly. Having a healthy credit card rating means that you can benefit from: 1. Rewards and points programs. 2. Purchase insurance. 3. Travel insurance. If paying off your credit card debt has become a problem, here are a few things you can do to handle it. 1. Consider a debt management plan from an advisor. 2. Try and consolidate multiple debts. 3. Talk to a bankruptcy attorney and discover your options. Car loan. You may need a car for going to your job that pays you. If you don't have the cash to pay for the car, what will you do? You'll have to take a car loan, and the payment will be spread through a given time frame. In this case, the car that you get is the collateral. If by any chance you fail to pay your debt, the lender can take back the car. Report shows that car loans are becoming longer and more expensive. So if you're working with a tight budget, you need to be careful to avoid getting stuck with the payoff. To avoid getting trapped in an expensive car loan, you can do the following. 1. Downsize your desire. Go for a less expensive car if that's what your income can handle. Limit your desire to what you need and not what you want. Our desires are often fueled by our emotions, and if not checked, can lead you into problems. If you'd like to drive a Benz but can only pay for a Toyota, why not go for a Toyota? If you desire a Toyota, but you know you can only take a debt for a Kia, why not go for a Kia? 2. Downsize your car for a less expensive one. If you've already taken a loan for the car of your dream and you're finding it a problem to pay, talk to your dealership and get the car replaced with a less expensive one. Personal loan. The terms for a personal loan are usually 2 to 5 years. This type of loan can be taken to make up for credit card debt. It can also be taken when you have personal emergencies and you do not have the cash. At a time when you need money to refurbish your home, you can take a personal loan to do this. It comes with interest rates that range between 5% and 36%. Sometimes you may not be able to pay back this loan, but there are steps you can take to manage the situation. 1. You can call your lender and negotiate with them to extend the payments or go on a hardship plan. 2. You can seek the assistance of a nonprofit credit counselor. They can help to manage your budget better. 3. If the debts are much, talk to a bankruptcy attorney. Medical debt. Credit to the Consumer Financial Protection Bureau. A 2017 study found that medical bills were the reason people were contacted by debt collectors the most. Routine visits to your doctor and some other health emergencies can lead to medical bill debt. If you're already deep in debt from other channels, this type of debt can make your situation worse. But there are a few things that you can do to manage this. 1. Set up a payment plan. Write exactly how much you're indebted to. Set a repayment plan. Adjust other financial needs to accommodate your payment requirements. 2. Use a medical credit card. Avoid putting your medical bill on a credit card. Do everything you can to pay your medical bills, no matter how hard you are on cash. Most medical providers do not charge interest. If you move your medical debt to a credit card, it clears off that advantage and can make it more expensive for you. 3. Hire a medical bill advocate. Here are some videos you should check out. How debt can make money. 11 lies you've been told about success. Well, folks, that's all we have for you today. I hope you enjoyed the video. If you have any suggestions for future videos, comment them down below, and we'll start working on them right away. With that said, have a great day, and I'll see you all in the next one.